שלום לכולם. דניאל, מה אתה אוכל? שלום
שלום,
לאף אחד.
שלום, שלום.
אה,
מרק פרואני,
זה נשמע דלישוס.
אחלה מרק.
מה יש בפנים? תירס או שועית? אחד מהם יש בפנים.
לא, לא זה ולא זה.
לא
יש
תירס.
בפנים אה, עלי בזיל וספינאץ', איך זה נקרא? אה,
תרד.
תרד, כן, תודה.
כן. אנחנו מדברים פה בעברית. Anybody here doesn't speak Hebrew? כולם מדברים עברית, מעולה. אוקיי. מה שלומכם? תד ככה מנענע בראש, צבי עסוק, כל השאר בזה. בוא נשים את כולם ממיוט, ומי שירצה לענות, דבר איתנו, שיוציא את עצמו ממיוט. מעולה. אז אנחנו נחכה עוד רגע או שניים עד שכולם יבואו. יצטרפו, כי עוד מצטרפים אלינו חבר'ה, אז ניקח עוד כמה דקות, ואז נתחיל. מה? מי רוצה לדבר קצת על... ראיתם את הכתבה על vision and beyond מהיום?
לא, תעדכן אותנו.
שהעירייה התחילה נגדם
איזה עירייה?
סינסינטי, על אי תחזוקה של הנכסים. העירייה הלכה לבית משפט.
של הנכסי,
מה?
של הסינגלים שלהם או של המולטי?
לא כתוב, כתוב רק שהם... העירייה התחילה שם proceedings. הנה, יש לנו מישהו שיכול לתת לנו אנחנו עוברים לאנגלית. So the city of Cincinnati, where is Jim? Jim, hi Jim. Jim, I need you. The city of Cincinnati started legal proceeding against them for not complying with city regulation in regards to maintenance and multiple complaints in the buildings for low maintenance. Now, city complaints to landlords is a regular stuff. I get it all the time from the city of Rochester. But if you get to the point that the city complained, it escalates very fast. So you got to do something with them. It's a headache. And the fact that they got to the point that the city, it's already, again, according to the article, ביזיון בית משפט, I don't know how you go call it in English, not complying with court decision or whatever it is, that's not good because
Hold the court in contempt.
yeah, exactly. That's not good because first of all, it's immediately gonna go and gonna hurt you financially because it usually comes with fines, and then on top of it, if they're gonna start doing work for you in your behalf, especially we're talking about it, and Cincinnati is a cold place, they usually charge you twice what it actually cost. So now the work gonna be done anyway, and then you're gonna be charged usually twice. I don't know how is it in Cincinnati specifically, but usually gonna cost you much more than it costs you to do it by yourself. So, and you're gonna end up paying it one way or another. If not, it's gonna go to taxes.
The last
What?
the last word I got for their properties in Cincinnati was that some already are, and they're all going into receivership.
Some of them, yes. Some of it said over there that there is control. There is on some of them there is receiver already.
But they're all going to end up that way.
Yeah, if they're not going to be able to recover, of course.
And we tried. I was
Jim, explain what a receiver is. I doubt how many people know what a receiver is.
basically the receiver is how do I describe somebody that's
A
basically
court, a
taking
court
care of the property?
appointed, yeah, a court appointed, usually it's a court appointed person that manage the property while it's being foreclosed.
Yeah.
So his job is to, he doesn't care about investors, he doesn't care about developers, all he cares is to maintain the building until it's being foreclosed. So he has 100% authority over there, and his job is to make sure that between the time that the proceeding started or he was given control until the time that it's being sold, the building is operating and being maintained properly. So basically, apotropos for the building, so that's
And
our
sometime later this year, that all of them, including the apartments in Lexington, they're all going to go into foreclosure, and they'll all be sold at the courthouse steps.
yeah, there is no way around it. That's the
They-
sad
they're-
thing.
We looked every which way we could. I had my attorney go through all the paperwork to see if there's any way to salvage this for any of the investors, and there's not.
The only way to do it now is approach the bank and try to buy the note.
But they're showing two liens. They're showing a first and a second.
Yeah, but once you take the first one, once you take the first, if you can get the first position, the next thing is you go to the second bank and say, listen, either I'm going to foreclose on it or take $10,000 and leave it. We did it a bunch of times back in Brooklyn, back in the days. You go to the second one and say, listen, I'm going to foreclose, I'm going to wipe you. So you better just take something and back off.
But the second mortgage on these is bigger than the first.
It
They
doesn't
did a
matter.
blank mortgage.
It doesn't matter. It's first position. That is the point of position. If you are stupid enough to be second position, a bigger loan at the second position, first of all, you're an idiot.
Oh, sure.
You're an idiot. If you give, you guys know, you understand what we're talking about? First position, second position on loans? If somebody doesn't understand what we're talking about, let me know. So basically, usually what the way that it's being organized supposed to is that who is first position always, by the way? Who is always first position?
Bank.
The
No,
bank.
no. Government on taxes.
Right.
No matter if you are officially first position, the actual first position in any case is taxes. So let's say you have $1 million loan and you owe $1,000 position, $1,000 in taxes. Taxes automatically by law come first. So first position always government. And then you go to actual position, and then it's supposed to be organized based on the size of the loan. But what happened is once in a while, somebody, I don't know, and give a bigger loan in the second position, and then the fact that you have a bigger loan doesn't put you first in line. So in order to do something like that, so let's say you want to come as you want to give as a second position a bigger loan. Basically, what you want to do is become first position. And for that, you need to go to the first bank and ask for something called subordination. So basically, you ask the first bank, say, listen, I'm giving a bigger loan, and we would like you to become second position. It's called subordination. So it goes under the first loan. Sometimes they're going to say no, and then you either don't give the loan or you become a second position. It's a bigger loan. It's a bad position to be in.
And this was not an intentional second loan as the other challenge.
What?
They took out, when they did the blanket mortgage, there were documents forged that made it the whoever wrote the blanket loan thought the first loans were paid off, and they were not paid off.
Okay,
And that's where this big problem starts.
That's when now we're talking about fraud and stuff like
Yeah.
that. That's a different story.
Yeah, it's a big mess.
Okay. So anyway, first loan, buy the loan, 50 cents on the dollar, and hope for the best. And then either you buy the deed or you hope that you can buy the deed. Anyway, let's start today. Okay, so we're gonna do it in English, obviously, since we have English-speaking guest, and it's a good way to practice our English anyway. So we all need it. I just celebrated this week, 2 days ago, 18 years in New York, in the United States. That was 2 days ago, and I still need to practice my English. So there is no,
Mazel tov.
thank you. There is no enough practicing English. The purpose of our Zoom today is, and we did it a couple of times before, but every time I'm going to use a different deal just to make it interesting, is to practice our Excel skills and look how we work with financial models. Obviously, there is no one way to do it, and there is no right or wrong way to do it. Whatever you feel comfortable for you. This is my Excel. I'm used to it. But again, different people do it differently. By the end of the day, what we try to understand and to conclude is, one, obviously, what will be the return, but also to build it in a way that's going to be easier for us to make changes that going to allow us some flexibility with Excel, because as we move forward with the deal and bigger and more complicated the deal, more moving parts we have, we want to build some kind of a model that's going to be easier to adjust as we go. And if we are using some kind of an Excel as a let's say like a work frame for a deal, you also want to change it between different deals, because different deals, different story. So this is my framework Excel, and then based on different strategies, different deals, I do some adjustment to each and every one of them. So there is not one financial model that fits all of them, but you try to build it in a way that's going to be minimum to change. So the way that we do it, and this is what is, just so you guys know, when you're working, especially with Americans that work with Excels, what is acceptable is that we change only stuff that is written in blue. Okay? So if it's black, you're not supposed to touch it. You try to change only stuff that is in blue, and that's going to change the financial model. We'll see down the road, going to change the financial model based on what you want. So you're going to see there is a blue stuff that we can change, and there is black stuff that is constant or going to change due to our changes that we do in blue, and there is red, whatever is minus or repayment going to be in red. So this is the what we see in visually, what we see and the changes that we see. Everybody on the same page? Good, perfect. I personally like, and again, there is no right and wrong here. So I'm just giving you the way that I do it. If you work differently, you can take a different approach, and that's fine as well. I do what's called syndication deals. Syndication deals is deals that I bring investors with me to purchase the properties. So my main concern when I'm building a financial model is how much my investors, my partner in the deal, gonna get out of it. Not what I'm gonna get out of it, what they're gonna get out of it. Why? Because if it's not gonna be attractive enough, they're not gonna join me to do the deal. So this is my main concern. How do I sell it to investors? Which means I need IRR, internal rate of return. If we need an explanation about that, let me know. But what will be the return to my investors? So this is my main concern, and it's always in front of me. So when you see here IRR, you're going to see it in almost every tab that I have. You're going to see that there is an IRR, because whatever I do and I change, I want to see how that affects it. So that is the IRR for my investors, not on the entire deal. This is why my investor are going to get. And everything that I do, I look and I'm going to see how it's going to affect what my investor going to get out of it. Okay, so you can see it. I have it here. I have it on the financial model. It's the same number, by the way, because it carries. So whatever I'm doing it in a way that I'm going to see how it's going to affect my investors. And this is how I start. I start by thinking what my investor going to get out of it. I need to be able to sell it to them. So in this case, you see the number is 19.7. This is the return on this specific deal, and that we offer to the investors. And later on down the road, we're going to play around a little bit and see how it's going to affect the IRR. Okay? So now that we have it, my Excel is built usually the same tabs. So I have tabs of assumption, which I put the basic assumption of the deal. I have one tab of the rents. And then if I need to do the rents, I'm going to change this tab and it's going to be carried to other tabs, because I don't want on the financial model all the rents, it's just too much. So I'm going to put it in a different tab and then I'm going to carry it to the different. I have one tab that just show me rents and expenses. I have one tab for the closing cost, how much the closing cost is going to cost me. And I have one tab for the financial model, the long-term financial model. And the last is amortization. I want to know in every given moment how much I owe the bank. So I have an amortization tab. People that not familiar with the language amortization, בעברית לוח סילוקין, או איך זה נקרא? טבלת, ברח לי השם שלו. נו?
שפיצר.
שפיצר, לוח שפיצר, נכון. Because since I'm refinancing or selling it in different times, I want to know what is the balance on the loan. I need לוח שפיצר, I need the amortization table, so I have that as well. Question until here, to this point.
Looks good.
Looks good. Perfect. Okay. So let's take a look at our assumptions, and I'll show you what I put here, and if you have anything to say about it, feel free. Okay. We usually in our properties raise the rent on an annual basis 5%. So I have my assumption about how much I'm going to raise rent. I have my assumption about rent increase. What will be my vacancy rate? You'll see that down the road I changed it, by the way. And how much I'm going to put a down payment. Again, all of it going to be changed. For example, you can see the down payment over here. If I change it to 2, it's going to be changed. That's what the point of changing only the blue ones. Sometime I'm assuming I don't like starting deals with zero money in the account. So usually I raise some money in advance. So I'm going to have some kind of operating capital. In this case, should have been blue. I put $150,000. That was the amount that I decided, $150,000. And then the building itself, we have one asset, 119 units, and the total square foot for the building. I'm not sure it's right, but it doesn't matter in that specific case. Ignore the asking price 1 second. The next step when I'm going to do this type of stuff is I'm going to go to the rents and I'm going to fill the rent roll. In that specific case, I got all the leases. I went over all the leases. I put the name. I put everything in the Excel. I put the rent. And now I know how much rent are they being charged altogether. What will be other charges that they charge the tenant, for example, for water, parking, whatever it is. And then I have my total charges and just put them together, total charges. And I'm going to carry that to my expenses and rents tab. So basically, rents and other charges, PGI, I have my vacancy. My vacancy here, I decided to put it at 6%. which gonna give me the PGI, potential gross income. Everybody know what a potential gross income is?
Yep.
Okay. So vacancy. Vacancy is a tricky thing, and it's depend. Everybody, oh, vacancy is 5%. It's true that it's 5% when it's a big building. If you have a single family house, it's not 5%. It's closer to 16. Should be 16. You want to see the calculation? How we get to vacancy rates?
Yes.
Yes. Okay. So let's say a lot of people think, let's say I have a 4-family house. Okay. Everybody thinks that if I have 1 unit empty, my vacancy rate is 25%. This is not how it's being calculated. The vacancy is calculated based on rentable month. So let's say I have 4 units. Each unit have 12 months of rent. I totally have 48 months of rent. Now, assuming that I have 1 unit that is being vacant that year, and it was vacant for 3 months, I lost 3 months of rent, right?
Yep.
Which means in that specific year, my vacancy rate was 6.3%. This is the actual calculation. Why am I saying that in a single family house, putting 5% rent is wrong? Because if I have 1 unit and it was vacant 3 months, I'm at 25% vacancy. If it was 2 months, it's about 16. So that's the minimum that you can put is like 16, 17% when you do some kind of a financial model. But let's say I have 119 units. And this is why size matter. And let's say that even 10 units being vacant for 3 months each, I'm still at 2% vacancy. That's the safety of size. Okay, everybody clear about how the calculation for vacancy is being done?
Yeah.
Question.
Yeah.
Where do you take into account the fluctuation, the move in, move out? Like you assume in the model that the same month you're releasing a unit, you're also renting it?
No, I took 3 months. I said 10 units, and each unit was empty for 3 months. You
Got
want to
it.
change it or say, okay, I'm paying commission, add another month.
Got it.
Again, I'm just giving an example here. You do your own thing and say, okay, I know that my average renting it take me 3 months. And I'm paying 1 month's commission. So altogether, it's going to be, the cost will be 4 months. Put 4 months. You should know your property. I'm just giving an example here.
Yeah.
Okay. But if you can see in the model, the bigger the building is, obviously, the relative portion of each property, each unit goes down dramatically. So here I have 20, I'm losing 10 units 4 months each, and I'm still not even at 3% vacancy.
So you're taking, when you calculate vacancy, you take already into account the fluctuation.
Yeah, that's the point of vacancy. That is the point of doing vacancy.
No, sometimes you have vacant units because I don't know, the unit is it can't be remodeled for some reason, or it doesn't have occupant. There's different reasons.
Of course there is different reasons, but one of them is the fact that you know for sure that not all units going to be rented all the time. So you got to put this into account. Obviously, if you have a bigger problem, your vacancy going to be higher. but it can be lower. And this is the point, because I see a lot about like, oh yeah, I have a single family still putting 5%. There is no 5% vacancy in a single family house.
Doesn't exist.
No, because even if you're losing a tenant every couple of years, you're still above 5%.
Yep.
Question about that, anybody? Everybody very quiet. If somebody has a question in Hebrew and want to ask in Hebrew, that's fine. I'll translate and I'll answer Hebrew, English, whatever you guys. I don't want you to feel uncomfortable asking question because of this. So in our case, we can see that we are at somewhere around 3%. I personally like to be on the safe side. We put 6%, so we almost doubled it. In that specific building, in every given point, usually there is between 2 and 3 units vacant. So we keep it. I put the vacancy rate at 6%. We'll play later on and see what exactly. How do we check and make sure that how much does it affect our financial model? So once I took the PGI, the potential gross income, and I took the vacancy out of it, what I'm ending up is EGI. EGI is effective gross income. How much rent I'm actually expecting to collect that year. Okay, that's the meaning of effective gross income. How much income I'm actually expecting to collect. Okay? And from that EGI, I'm going to take off my expenses, which I like to put next to it, so it's easy for me to take a look and also to calculate percentage to understand more or less how much my expenses coming out of my income. Now, I can tell you out of experience, you should be between, most of the time, between 45 to 55%. Usually, if you do a calculation that is dramatically different than that, either way, you need to ask yourself question, why is too low or why is too high? So for example, in smaller buildings, sometimes you're going to see that the expenses are higher, or in buildings that they pay 8, suddenly you see the expenses are 75%, but you not to keep it you want to understand the percentage, and you want to know more or less how much it should be. It should be somewhere around 50%. Okay? So in this case,
Where's the property management?
in this case, okay, in that specific case, the property management goes under these 2 categories. First of all, there is a payroll, and the reason in that specific, we'll get to it in a second. Okay, we'll go line by line. Okay, so we have real estate taxes. In this case, real estate taxes $138,000 a year. Insurance, insurance came out to about $1,600 per unit per year. Okay, in that specific building, we have 5 different insurances. Okay, so we have the basic one, which is liability. Liability means insurance. What happens if somebody falls and sue us? So it's a liability. There is the property insurance. What happens if the property gonna, I don't know, damage, gonna be a fire, whatever it is. So we have liability, the property insurance. We have loss of rent. So let's say a property burns down. I lose the value of the property, but I also lose rent. So we are insured also for rent loss. So I'm going to get money for the building to fix it, but I'm also going to get compensation for the lost rent while I was working on the building to fix it. Loss of rent. Flood. This is Houston in that specific case. So Houston, I don't know if you guys know, 50% of Houston is a flood zone. So flood, and the last in that specific case, we have rain and hail. So if we have hail damage, we are covered for that. That's different than other insurances. So when you guys take an insurance in a specific area, you need to figure out what is a specific needs in that specific area. Do I need flood? I don't need flood, stuff like that. Hail and rain, that's a specific insurance, usually doesn't go under. I don't know if you guys know that above a certain wind speed, your insurance doesn't cover you. So let's say you have damage or under, so different insurances have different specifics. In an area that you have winds, you want to be extra covered. So we have 5 insurances in that specific case. It came up to about $1,600 per unit per year. Maintenance, we usually do $750 per unit per year, with the understanding that not all of the units going to need work. So some units probably going to need more work, some units going to need less work, but the average is about 750. This is out of experience. Again, smaller the building is, higher the number per unit should be. Obviously, if I have a single family house, 750 in renovation per year, probably not going to be enough. Every little thing that's going to happen, because again, as a relative proportion of each unit is bigger if the building is smaller. Okay?
Kyle, how do you calculate it? I mean, do you calculate it percentage-wise? Because percentage-wise, it looks like
I don't do percentage. I usually do on bigger buildings. I do 750 per unit.
just like a general number.
Yeah, experience.
Okay.
Okay. There is people that do it as a percentage. Again, by the end of the day, when you know your building over time, you have an understanding. Jim, you know how to say what is your average?
The average of
Maintenance per
Repairs,
unit.
maintenance.
we use 5% as the general rule plus a 5% maintenance reserve.
5% of what?
The gross income.
So 5%. So if you're talking about this, you're talking about 5% of that. Okay. So that's going to be 5%.
17,000.
So it's not that far. Again, keep in mind that on a building on this size, it's not that far.
We typically underwrite like the bank because the bank makes assumptions whether the money has been spent or not. The bank will look at the last 2 years' tax returns. And if those tax returns don't reflect what the industry averages are, they'll make their own assumptions.
Yeah. First of all, this is a very important point to make. You need the guys to understand that it doesn't, for example, there is people that, I don't have management because I manage it myself. When you go to finance it, the bank doesn't care. They're going to say it's still 5% management or 10%, whatever it's acceptable in the area that you're working in. Because the bank says, okay, what if something happened to you tomorrow? So you can go below the minimum that is acceptable in the area.
But what Jim said he was taking that he knows 5% plus 5% like contingency.
So
right? Is that
yeah, I usually like to do 750, and worst come to worst, it's gonna cost me less, and my investor gonna make more money. That's fine with me. So what I do is I have the maintenance, which is 750, but on top of it, and we'll see it later on, I take 5%. So you see I have an extra 5%?
Yep.
Utilities. What?
Does it include cleaning? I mean, garden, when you're saying maintenance on your end?
Yeah, so you need to look at it in that specific case. Again, different properties, different story. But in that specific case, basically what you have here goes like this. I have regular maintenance. I have payroll because there is a maintenance guy working in the building. So when you talk about gardening, he is the one that's doing it. So that's included also in his payroll.
Okay.
And on top of it, there is a management.
Okay.
Okay. And in that specific case, I also have, for capital expenditures, I took another 5%.
This 5% is beyond the 150 that you took on the assumptions
So
page,
in that,
on the first page?
So in that specific case, what I did is I took 150 and I said, okay, I'll put 150. So I'm starting at 150, and then to that 150, I'm going to add $30,000 every year. And one day, if I'm
Okay.
going to need a big chunk of money, I'm going to have it. I'm not going to have to ask
Okay.
my customers.
Got it.
Okay. So as I said, there is a maintenance guy and a manager in the building, so they're getting some kind of a payroll. So we have the payroll. On top of the payroll, we have 3% management. Usually, I would put 5 at least, but because some of it goes to payroll, so that balance it. Refuse is garbage. So this is a commercial property. This is not a private house. Usually commercial properties, you need to pay for the garbage to be removed, and it's called refuse. So that's for the garbage. Admin is everything that goes to the office, stuff like contracts. Sometimes there is internet, phones, stuff that is around the managing of the building. In that specific case, the admin is very, very high. And the reason that is very, very high is because the owner in that specific building is a very old-fashioned guy, spend money on stuff that he doesn't need. Because he have it right now, I put it on my financial model. Usually it wouldn't be there, but I took it into consideration because it's there now. If I'm going to be able, once we're going to start terminating contracts over there, this number should go down. Admin at $20,000, that's a big number for one building. But this is how it works, so this is where it is. Landscape, we don't have here because we have the guy that does it, so there is no landscape expenses here. But I'm assuming that I'm going to make a mistake and I'm going to forget something. So for me, I put another $10,000 as extra expenses, something that I can account for right now, that my cushion on my expenses, I put a $10,000 extra expenses. Okay. This is usually regular operating expenses. Now you guys got to remember, different places, different expenses. So when you take a new building and say, okay, I'm going to buy this building, or I'm going to do my own thing for a building, you need to take a look at it and tell yourself, does my expense list cover the actual expenses of the building? If I have a building that I have students and I'm providing them with internet or TV, or I have a gym or whatever it is, you got to adjust your expense list according to that specific building. So there is the basic stuff that you're always going to have: taxes, insurance, management, maintenance. But then you need to go to the specific of the building that you have and say, okay, is that numbers reflect the actual? If I have a swimming pool in a complex, that's a different story. If I have, so I'm going to have to adjust it accordingly. Okay? So it's important to remember that nothing is written in stone. It's a frame, and then you take this frame and you adjust it according to that specific building that you're working at. Okay?
Yep.
Yep. So this is a regular operating expenses. Why? And I'm separating from two other expenses that I'm going to discuss in a second. And why do I separate them? Because for valuation purposes, this is a list that you need. Okay? For valuation. When I do a syndication deal, usually I take a fee for running the deal. So we have a little fee that we take, and then we do capital expenditures that usually not used to calculate for valuation calculation. So I separated them here. But for my expenses, for my cash flow, I took the full number.
Yeah.
Is that point clear? I'll assume the answer. Everybody's very quiet. I assume the answer is yes.
Yep.
Okay.
You don't do you differentiate between capex that you do in the units and like capex you do in public spaces, like I don't know, roof, gutters.
Okay. Let's separate capital expenditures from regular maintenance. Okay. Regular maintenance, a faucet was broken. Okay. A doorknob need to be replaced. A window was broken. Okay. That's regular maintenance. That goes under this category. Okay. Then there is capital expenditures. Capital expenditure usually are big stuff. Okay. If I go and do a roof, if I do a major renovation, if I do, I lived in a building that there was 400 units, and they changed all the windows of all of the entire building. And we're talking about expensive windows, not the small double-hang windows. We're talking about huge, massive windows each, probably millions of dollars. I'm serious, millions of. It probably cost millions of dollars. So that's capital expenditures. That affects the value of the building. So you need to think about it. If I put a new roof, cost me $30, $40, $50, $100,000, sometimes can cost more than that, depends on the size of the building. That affects the value of the building. If I change a faucet, doesn't change. So also for tax purposes, it's different. And this is another thing. Capital expenditures go under the regular depreciation, 27.5 years or whatever it is, while maintenance work being fully depreciated at the same time. I get a tax deduction at the same.
Yeah.
So it depends. So CapEx usually bigger stuff, more expensive stuff. And for that, I need to be ready. I can come up usually, $500,000 out of my pocket. Okay, I'm going to do roofs for $500,000 right now. Usually you're not going to have it. Nobody keeps this amount of money. So you need to be ready for it. The way for us to be ready for it is to take $150,000 in advance. And then over the period of time that we're holding the building, we're adding to it a little bit with the hope that if we need it one day, we're going to have enough money or very close to it that we're not going to have to go back to our partner and say, listen, guys, we need more money, because basically where are you going to bring this money from? Either you're going to take it as a loan from somewhere if you can, or you're going to have to bring it from home.
But like the big projects, let's say you need to replace a roof within the next, I don't know, 2-3 years. So you already implemented here in the model?
So in that specific case, the roof is relatively new.
Okay.
So I know the roof are new. I know I have time.
Yeah.
If I came and the roof was old, I would put all the money for the roof. I will raise the capital from day one. If I came and said, the roof was done 15 years ago, you better have all this money ready. It's coming in the next couple of years.
Got it. And all these stuff is all these action items is stuff you get during the due diligence, or you have any data before?
So some of it I have before. There is stuff that is available before. Taxes, you can go to any building today.
No, taxes, yeah, but like
Yeah.
I'm talking about the capex mainly.
I don't understand the question. CapEx is
No, I'm
calculation
saying-
that I do.
Yeah.
I do. But when I go see a building, I say, okay, nice building. I ask this question, yeah. When was the roof done? Yeah, that's a question that I do when I go to see a building. So I say, okay, roof is a big thing. When was the roof was done? I want to know this stuff in advance, obviously, because how would I give them an offer if there is 10 roofs over there. Let's assume that each roof, okay? It's a big. I have 10 roofs over there. Let's assume that each roof is 20 grand.
Yeah.
If I know that I need to do it in the next year or so, this is coming out of the asking price.
Yeah.
This is why it's a capex. It's something that affects the value of the building. It's so big that it will affect the value of the building.
Got it.
Okay, questions? Let's go, guys, to a closing cost. I don't know. Now, closing cost is also something that changes between the location where you guys work. So, for example, in New York, there is mortgage tax. So in New York, I'm going to have to add 1% mortgage tax. This specific deal is in Texas. In Texas, there is no mortgage tax. So I left it as a 0. Another question is, do I use a mortgage broker? I love using mortgage brokers, but I need to pay them. So I put mortgage broker fee. Loan expenses, whatever it is that there is loan expenses in that specific case, you need to open a file, you need to do environmental, phase 1, phase 2. If you guys don't know what phase 1, phase 2, let me know, stuff like that. So I put that into a calculation in other loan expenses, title insurance, legal fees. I need to open a new LLC, that costs money. There is some recording stuff, regular stuff, but this is the 2 major items that I want to discuss with you guys, because I find that many times people don't realize that they need it. This is something that happens when you buy commercial properties, usually doesn't exist for single families. When I buy commercial properties, remember, by the way, now I'm going to connect it to our first conversation. Remember that we said, who is the first position? We said the taxes, right? So the bank knows that the sensitivity point for them is that if I'm not paying mortgage, I probably don't pay my taxes. And therefore, tax is going to come before the bank. Right? So the bank said, you know what? We don't trust you to pay taxes. You're going to give us the money for the taxes, and we're going to pay in your behalf. This is how we're going to make sure that you pay taxes, and we stay first position. How many of you guys know that the bank do that? Sarit knew. I'll take Sarit as the only one that today because I see only Sarit. Okay?
You can mark me as well.
Yeah. Okay. So usually when you have a loan like this, you don't pay taxes directly to the government. You pay the bank, and the bank pays the government in your behalf. Same for insurance. This is how they know that you have insurance. They don't trust you to keep your insurance current. They charge you for your insurance, and then they're going to pay the insurance in your behalf. For them to have enough money to pay for it, so they're not going to start at 0, at closing, they're usually going to ask you for half of the cost of the yearly insurance and the yearly taxes in advance, and they're going to put it in an escrow account. So whatever your taxes and whatever your insurance is, you're going to have to come up with half of the yearly amount and give it to the bank at the closing. In this case, you can see this is $150,000, $160,000. You don't want to find it at the closing date that you need the extra $160,000. That's a lot of money to find out the day before the closing that you need. So we put in a calculation and say whatever the taxes are, half of it I'm gonna need in the closing. And then I usually take another $15,000 as a contingency. If I miss something, the bank asks me to do something that I didn't took into consideration. And suddenly a closing became a $400,000 expense.
The commission is the broker fee.
Which one?
There's commission zero. But you
Usually
mean
if I need to pay somebody, yeah, in that case I don't need to pay anybody, so it's zero. But usually if I'm gonna have to pay somebody, then yeah, that's gonna be a commission.
got it.
Tal, what is the mortgage tax?
There is states in the United States that when you take a mortgage, you need to pay tax for it. So for example, in New York, it's a 1%. So every mortgage that you take in New York, in the state of New York, you need to pay the government 1% of that loan as a tax.
Very odd. Tax not on revenue.
What?
You pay tax not on revenue.
You pay tax in New York, you pay tax for everything because they need to pay for all the shit that they're doing. They need to pay for it somehow.
Okay.
So mortgage tax is 1% in New York. And that in that case, by the way, let's say you do a deal like this, that's a lot of money, by the way.
Where do you put the due diligence costs?
So it depends if I have due diligence or I don't have due diligence cost. In that specific case, I didn't have that much of a due diligence cost. I have here and there, I have enough cushion to use it. So first of all, you see that I have a contingency here.
Yeah.
Okay, if I need it. In that specific case, I did most of the due diligence myself, so I didn't charge the deal for it as a cost. But if I really need, I have here, you see?
Yeah. Yeah.
But in that case, it's part of what I do as the only contingency cost that I really add here, I need to pay somebody, is in that specific case, I bought a plumbing company to run cameras in the main sewer lines. So it cost me a couple of bucks, but it wasn't that bad.
You don't use an engineer on an ongoing basis, like to check the building?
It depends on the deal. It depends on the deal. In that specific deal, I didn't add to for two main reasons. One, that specific building, one was fully renovated 6 years ago, and second, when I came to buy it, it just passed the city
Inspection.
inspection for structural inspection.
Yeah.
That specific, what the engineer, they just did it.
Yeah.
So they pass the structural. So plumbing, I can see, I brought whatever they could to run cameras in. Again, you can inspect all of it.
Yeah.
There is no basements, it's slabs. It's all built on a slab. So there is nothing that you can see.
HVAC?
Sorry?
HVAC?
They just have it. It's all new, 6 years old.
Got it.
So
Okay.
there's nothing much to...
No, not too much room for a mistake. Yeah.
Yeah. In that specific case, don't get me wrong. Other deals, different story. But that specific one, that. Now, different deals, sometime I'm going to bring my constructor. I don't going to be the engineer, but I'll bring my GC. And I trust him. So if my GC like, listen, this is a story. If you work a lot with GC and you have somebody that knows what he's doing, he's as good as an engineer.
Yeah.
I can tell you that in Brooklyn, usually the engineer used to make the plans based on what the GC told him to do, not the opposite. So it depends how good the GC is. Some of them are very, very good, very experienced, and they know exactly what will be the best solution to solve a specific. And sometimes they go, "Oh, the engineer, this is what we're going to do." And oh, you know what's a good idea? I'll do this the way because it's easier for the GC. It's still good enough solution for the problem, whatever it is. And if you want me engineering problem stories, I'll give you some. Probably the most interesting stories there is, by the way. I'll tell you at the end, if you have time, I'll tell you a funny one, by the way. I'll tell you a funny one. Where were we? Closing cost. Okay, so we good with the closing cost?
Clear.
Everybody the same page, we're good with the closing cost? And then bring us to financial model. Okay. So now we're going to go back 1 second to the assumptions. And now we're going to discuss something else, which is how do we work with our investors and what is our vision for the deal. So let's start actually from the vision. And this is very important because it's going to affect the financial model down the road. We need to think when we're building the model, we want to think, okay, how are we going to do it? I don't like buying building for 5 years, which is a lot of people do it. I don't like it. If I find a nice, good building, I want to keep it. So when I build a financial model, I usually build it 10 years in advance. So I'm looking 10 years forward. It doesn't mean that I'm going to hold the building 10 years. But my financial model going to look and say, what happened if I'm going to hold it 10 years? And while I'm holding it, I'm adjusting, which means if somebody going to come 7 years down the road and going to give me a really nice offer, there is a good chance I'm going to sell it. At the same time, maybe 10 years down the road, we're going to be in a financial crisis and the price is going to be horrible. And we say, you know what, let's hold it for another couple of years. So you need to understand this is a theoretical mathematical game that we are playing. Nobody really knows what's going to happen 10 years from now. So it's all assumptions. So for me, I'm saying, okay, if I'm going to hold the building 10 years down the road, I'm probably going to want to extract my equity out of it. So in that specific case, we said, okay, let's assume that we're going to finance it or refinance it more accurately in 5 years. So what you're going to see here is that I have loan year 1 when I'm buying it, but I also have loan year 5. Okay? And since I need to close the financial model, it's got to be a closed. If I want solution, I want IRR, I want to see returns, I need to assume that I'm selling it in some point. So we have a sell at year 10. Okay, so that was our vision for that specific deal. That was our vision to how the deal gonna work. We're gonna buy it right now with a loan. We're gonna hold it for 10 years. Year number 5, we're gonna refinance it. Year number 10, we're gonna sell it. Okay?
Yes.
Great. And now we said, okay, so if we're buying it and we are raising capital, I usually work with my investors in what's called preferred return, which means I'm giving them an advantage of getting back their capital before I am. And usually what we do is the way that we do it is that the preferred return is 7%. Some people do 8, some people do 9, some people do 6, I do 7. There is no right and wrong here. It's all about what we're doing. I have other deals that I offer 9. I have other deals that I didn't offer anything. So again, it's not written in stone. It's based on that specific deal. Some deals we do more, some deals we do less. It depends. Who knows what a preferred return is? Who needs me to give you an example of what I mean? Everybody knows how it works?
I prefer that you give an example.
Okay. So we work, it's called a preferred return. Preferred return means that the investor gonna get an advantage in getting paid before the GC, the general partner, GP. Let's say that I'll take Sarit as an example, okay? Let's open a new tab and I am the manager of the deal. My name is GP, general partner, okay? And I have an investor, Sarit in this case. She is a limited partner and it's called LP, limited partner. So maybe you're gonna see general partner, limited partner. This is what I mean. General partner, whoever runs the deal. Limited partner, somebody that is a partner of a deal, but it doesn't have any management positioning, okay? As a GP, I usually put less money than the LP. So let's assume I put $10,000 and Sarit put $100,000. Let me do it a little bit bigger so you guys are gonna see it. Okay? And I'm gonna change it. I'm gonna put myself under you. It's gonna be easier to understand. Okay? And we are telling you that we are giving the LPs 7% preferred return. So we're giving Sarit 7% preferred return on our money. Which means that will be 7% of $100,000, $7,000. And the preferred return on my money after Sarit, because after Sarit gonna get her 7,000, it's gonna be my turn to buy my preferred return, which is $700, 7% of 10,000. What does it mean? It means that every year, the first $7,000 always gonna go to Sarit. So let's say something happened in that year, and I have only $6,500 to give to my investors. All of them gonna go to Sarit because she's getting the first 7,000 in any case. I have only 6,999. She's gonna get all of it. I get 7,000. She will get all of it. What happened in 7,001? She will get 7,000. I'm gonna get 1 because the next 700 is mine. So 7,100, she getting 7,000, always the first 7,000, I'm gonna get 100. We get to $7,700, 7,000 to her, 700 to us. But what happens above it? What happens if I have 10,000? So now we're going to a profit split. It depends on the deal. In that specific deal, we are doing 65 to the investors and 35 to us.
This is the waterfall.
That's the waterfall, exactly. So let's say in that specific year, we have $7,800 to distribute it. Come on, guys, help me here. Sarit will get
7,000.
7,000. After Sarit, I will get
700.
700.
And the remaining 100 will be split 65-35.
Exactly. 65 to Sarit and 35 to me. And she altogether gonna get
7,065.
65. And I'm a general partner, will get
735.
735. Why is it built this way? To give me, as a general partner, the one that runs the building, the motivation to overperform. So, first of all, you're going to give your investor your minimum. If you want to get paid, you better perform. Because if you're not performing, you're not getting money. But if I'm overperforming, my relative share on the profit is bigger than what I put in.
Tal, it's only interest though, right? It's not that now the following year the LP has $93,000. It's not the 100 less than 7,000.
What?
No, this is profit distribution. Whatever's
this is
left,
profit distribution. That has nothing to do with equity. Okay?
And what happened if you made only $5,000?
it goes to
Wow.
you.
All goes to you. 7,000, the first 7,000 all is yours.
So
let's say
then
something
the
happened.
2,000.
Something happened and 1 year I have only 5,000. I didn't get to your minimum. Your minimum is 7,000. Everything is yours. If I got 7,100, 7,000 is yours. Always 7,000 is yours. 100 is mine.
No, but it's actually rolling. No, like
What?
she's supposed to get the 2,000 from previous year that you owe her.
It depends. There is different way to do it. I didn't want to get into it. There is different way to do it.
Yeah.
But you're
Okay.
rolling. There is some of them are rolling, some of them are not. The way that I do it, I'm not rolling it next year. For me.
Okay.
But there is deal that people do it, yeah. Some deals are rolling, it's accumulating. Sometimes it's rolling, but you get paid at the end of the deal. There is different ways to do it. There is a million different ways to do it. But you're
Yeah.
right. There is some of the deals it's rolling, yes. So there is deals. What Ed is saying is that there is deals that it's what's called rolling, which means if you got 5,000, I owe you 2,000. So in this year, it's going to be 9,000. It depends on the deals. I don't do it this way because it's a never-ending calculation also.
Yeah.
I do it on a yearly basis.
Then there's another layer of complexity. If you overperform, then it's sometimes also capped. Like it's not going to be always 65-35, right?
Again, you can break it down even further. I don't do that. For
Okay.
me, this is where I am. This is where I stop. 60, you're always going to get 65. So some people are like, okay, over a certain percentage, I'm even going to get more than 35. I'm going to get 50. I don't do that. Again, added level of complexity to the deal. I usually don't do it. This is the percentage. It's going to see the same percentage the entire time. Again, there is no rules here. You guys need to understand. You can do whatever you want. Okay, you can come and say there is no preferred return. It's 50-50. If your investor is willing to do it, it's good enough. The way that I build it, remember what I said, the first thing that I said? I said, I always go to what my investor gonna get out of it. So let's say, I would say, you know what? I'm not doing any preferred return. I'm gonna do it 0. But we're gonna do 50-50. They're gonna get only 15% on return. If I thought that this is good enough, I would say, fuck it, you know what? I'll go for it. Can say, you know what, I don't need that. Let's do just 35-65. Not make that to the different. That's fine as well. That can work. But since we originally started at 7.7, they got that. In that specific deal, the return went up from what I originally planned. So they actually got better than we expected at the beginning.
Tal, what is preferred equity management?
What?
under profit share, you have preferred equity investors, and underneath that, you have preferred equity MGT.
Not the return, not the
Management.
7% return, not the preferred return, the preferred equity. This is how much you're getting. It is 7,700 that I explained.
Yeah.
That is what it is.
What goes to the GP and what goes to the LP?
Yeah.
Ah,
The investor are going to be the LPs, and this is going to be the management is going to be the general partner.
got it.
Questions?
Clear.
Okay. So again, whatever I'm doing, and the way I build it, always look at this. This is what drives everything that I do. I want this to be high. This is why my LP is gonna get. If they're gonna be happy, they're gonna put money in the deal. This is how it works. Okay, so this is where most of my equity capital comes. So I need to be attractive. Okay.
How did you get to the 19.7%?
We'll see in a second. Okay, we'll get to it in a second. Okay, so now that we know how we're building it, we said, okay, so how much money do we need? Okay, so we know how much our closing cost. We know how much our capex is. There is an acquisition fee that we charge, and we played with the numbers to get to whatever return we want. And we said, okay, our offer will be 9.425. Okay? If I'm doing that, obviously I don't want to come all of this money out of my pocket. I'm going to take a loan. So the value is going to be the purchase price, because whatever bank I'm going to go, going to give me a loan based on my purchase price. And usually the LTV will be around 70%. In that case, we put 70%. It came out that our purchase loan should be almost $6.6 million. Okay? Which means just for purchase purposes, I'm going to need $2.8 million, which is 9.4. But I know already that I need extra money, which means if the total cost of the deal is $10.3 million and 6.6 out of it going to be a loan, I'm actually going to need equity of $3.7 million. And the way that we build it, and again, there is no rules about how you do it. You can do it any way you want. The way that I do it is usually my LPs put 95% and I put 5% of the deal. So my investor, I'm going to need 3.5 million, and it's going to be my responsibility to come up with about $185,000. Okay?
So you're putting $150,000, but you're getting $300,000 for acquisition fee.
Yes.
Okay.
Now, when I'm calculating this, the loan, I need to double check two things. One, that my LTV is not too high because the bank not going to give it. And the second thing that I want to look at going to be debt service coverage ratio. Debt service coverage ratio is the ratio between your NOI, your net operating income, and your annual mortgage payment. If this number is lower than 1.2, which means your NOI is not 20% higher than your mortgage payment, the bank not going to approve the loan. The bank want that your NOI will be at least 20% higher than your mortgage payment. This is how they make sure that you have enough money to pay the mortgage even if something happened. They have this 20% cushion. That is very, very important when you do commercial deals. If you guys don't understand it, I'll explain it again. Everybody clear about that?
Yep.
So now we know how much it cost us. We know how much loan more or less we're gonna get. And we are also understand and we know that we have enough cushion because I have 40% cushion. They asked for 1.2, I got 1.4. I have enough cushion, which makes sense that the bank gonna give us the loan. I can tell you that already they told us that at least 67% they're gonna give us. So I even have more. We try to convince them to give us the full 70. Okay? Going next will be what will happen 5 years down the road. 5 years down the road, the first thing that I want to evaluate is what will be the value of the property 5 years down the road. Now I'm guessing here to a certain level, but I try to do a educated calculation. So I'm saying, okay, what is a cap rate? What is a reasonable cap rate to use 5 years down the road? And I said, today, market is not that good for this type of properties, and the cap rate is around 6.5. I'm just going to keep it because if it's going to be bad, it's going to be bad. We're going to play later on down and see what happened if I made a mistake. But I'm going to use that cap rate, and I'm going to take and I'm going to calculate the value 5 years. How do we calculate value of a property like this? Who knows the equation? Value equal NOI divided by cap rate.
Yeah. Future NOI divided by cap rate.
Yeah, this is a commercial property. Is the value of this property. This is not comps. This is not a single family. Is a question of how much money it's making. It's a business. So if I decided that the cap rate is 6.5, and I know my NOI because I know how much rent I'm gonna collect going up 5% every year, I can evaluate, said what will be my NOI 5 years down the road, and I'm gonna divide it by the cap rate, and I'm gonna get a value. And I'm gonna come and say, okay, my LTV will be 67 or 70%. You can say that it's 70%, doesn't matter. 70%, let's do 67 because we have now 67, let's do 67, which means I'm going to get a loan of $9 million. Okay? I put the terms and I know my debt service. And the next thing that I want to make sure is that my debt service coverage ratio is still above 1.2. Don't forget, this is 5 years down the road, so my NOI higher. I'm still at above 1.2, so there is a good chance that the bank going to give it to me. I have cost of financing and financing fee. Gonna cost me, remember, cost of financing is the same story. I need to pay the bank, I need to pay all this stuff. It's gonna cost me, maybe it's gonna cost me a little bit less, but it's better to be safe than sorry. And I'm gonna get out of this financing about $9.2 million. But I already owe money, right? I have a loan that I took year number 1. Now it goes back to my amortization. Since I paid it for 5 years, this $6.6 million is now only $5.9 million loan, which means that after I'm gonna pay my debt, I'm gonna end up with $3.2 million in my pocket, which I'm gonna pay back to my investor and myself as a return of our equity on the deal. So they have in the deal $3.5 million, my investors, and they're going to get back about 3.1, and I have 185, and I'm going to get about 163, which is, by the way, percentage-wise, there is no 95%. They put 95% of the money, they're going to get 95% of the money that came from the financing. Okay? And my investor and me going to stand up with $400,000 and $21,000 in the deal. Question about that? And we're gonna do the same trick for 10 years down the road. So we do whatever the NOI, this is our value, cap rate, this is our value, how much gonna cost us to sell it? 6%, you can say it's gonna be more or less, whatever you think it is, with whatever number you feel comfortable with. I'm gonna get out, how much I'm gonna get out of the deal from, from the sale. I'm gonna pay the debt, right? I took a new loan, so now I still have debt. And how much I'm gonna get after I'm gonna pay the debt? I'm gonna have $10 million out of my pocket, which is, first of all, I'm gonna give back my investor their money, right? Their equity. Second, we're gonna get our equity, and then we're gonna split the profit according to whatever decided at the beginning here. And this is what they're gonna get, and this is what we're gonna get. Now that we have all this number, I'm going back to my financial model. And Sarit, this is the question to how do I get to 19.7%? And I'm gonna say, okay, how much money they're gonna get? Year number one, how much money my investor gonna get out of rent? So you can see that in year number one, I'm not getting even to their minimum 7%. So they're getting everything. We have actually almost 6%. Year number two, we're getting to their 7% and part of my 7%. So I'm going to say, okay, they're getting 246. Year number three, you're already eating their 7% and we're above my 7%. So there is a 65-35 split. But what happened, and we go on like this during the years. What happened in year number 5? On top of the rent, the split of the rent, they're getting $3.1 million, right? From the financing. Everybody with me?
Yep.
Everybody there. So year number 5, they're getting almost $3.4 million, almost $3.5 million. And going back down the road again, the rent, just rent. At year number 10, they're getting about $7.2 million. And now we're going to do a calculation of IRR, internal rate of return. Internal rate of return says, how much money did you put? How much money did you get during the years? And we're going to convert it to an annual return, which is 19.7%. Saray, did you understand how we got to it?
Yeah, thank you.
Now, if you want to look at it the way that I do it, that if you want to look at it on an annual basis, how much return do I get each year compared to how much money do I have in the deal in that specific year? I have another cash on cash for the investor years. I have it on an annual basis. But this
Why
is
don't you reflect the cash on cash at the summary?
sorry.
Why don't you reflect like you reflect the IRR at the assumption tab? Why don't you reflect also the cash on cash?
Because IRR is a more accurate way to look at it.
Okay.
IRR is a more accurate way to look at return of a deal, this type of a deal, because it's multiple cash flows in multiple time schedules. So for me, I personally think this is a more accurate way to look at it. There is another thing that you do. You put too much, you start confusing people, especially people that are less experienced. So when I look at it, you need to understand. I talk to many times to investors, members, partners, any way you want to call them, that are less sophisticated. You can't start, oh, and then what is... So you need to give them one way to look at it, that they're like, okay, IRR represent your average annual return. They can accept that as an answer, which is it's a true answer. It's not like I'm lying to them. It's an accurate answer. But if you're going to start making it too complicated, don't forget you need to sell it as well.
No, I agree. I understand. I fully understand what you're saying. But sometimes, I don't know, from my experience, when you tell them, okay, you put 100,000 and at the end of the road you get 300,000, then it's, it's sometimes it's easier for them to digest. But again,
Again, two different things what you're asking right now. You're asking how do I present it, and you ask how much are they. I can tell you that on my presentation, when I'm giving a presentation, and you can see this little calculation here. Okay, you see this little calculation here? I do exactly what you're telling. I say like, you put 3.5, you're gonna get 12 million. And it's 3.6 times the money that you put. So I do what you, but we are not there. We are not marketing it now. We're looking at the financial model now. Okay, two different things. But I agree with you. It needs to be simplified for them. So when you ask, when you're gonna get, if you get my PDF, it said there is a table. It's like you put 3.5. After 10 years, you get $12 million. I agree with it.
got it. Tell me, how do you? I see that.
Yeah, that's marketing. That's different.
Okay. I see that the maintenance costs, there's also some kind of acceleration annual
On my expenses?
on your expenses, yeah.
Yeah, like I do, again, we need to be realistic. There is inflation and everything that we do also go up. So I can't say, oh, just rent goes up, but expenses doesn't go up. So I need, if rent goes up, expenses go up as well.
No, of course. But where is the parameter where you decide that it's, I don't know, if you increase the rent by 5%, so also the expenses are going to increase by 5%.
So expenses, inflation, average inflation over a long period of time. Rent is also what the rules allows me to do. So usually what we do, and I can explain how technically I do it, I raise rent 5% every year. So this is what I put in.
Got it.
Okay. Technically, this is what I do. I raise rent 5% every year. So that's what I put in the financial model. Now the question goes like this, and this is something that I do, which is, again, I do it for myself, but also if we're talking about marketing, I do it with my investors. So I'm going to take you and I'm going to use you as an example then, okay? What I tell my investor is very simple. I said, let's assume, I'm going to say it in Hebrew for a second, Jim. Excel סופג הכל, נכון? Excel can absorb everything. So maybe everything that I do here is wrong. Let's play a game. I will ask you a question. You're going to come up with a number. And if you guys want to write me your different numbers, I'll give you a second to everybody. You can text me your different numbers. What will be the minimal return that if you'll take it, even if everything went wrong, you still say, you know what, it's worth to me to go into the deal? What will be the minimum return that you still say, you know what, it's worth it to me? Give me a number.
10%.
10%. Yeah, great. This is everybody said the same answer. Anybody wants to say a different number? That's fine with me. But let's say 10% as an example, because it's a very common answer. So you say, if I'll get above 10%, even if it didn't work the way that you told me, I still going to end up and going to say, you know what, it's worth it. Okay? So what I do with investors, and I do it myself before I do it with the investors, I said, okay, let's see how sensitive this Excel is to me fucking it up. Okay? And the first thing that I do is I come to myself and say, okay, what if the bank not going to give you the loan that you want? The bank going to say, Tal, I'm not giving you 70%. I'm going to give you only 60%. So I go here, and this is why I have my IRR in front of me all the time. I want to see what happened. What happened to my IRR? 18. So now I'm going to say, you know what? Let's make it even worse. The bank not going to give you the, it's not going to be 6.5%, it's going to be 7%. By the way, I already got less than that, but this is for the argument or playing games. I'm still above 70%. So say, okay, I'm good with that. If the bank not going to give me what I want when I purchase it, that's not bad. What happened if it's going to happen the same story 5 years down the road? First of all, I was wrong with my evaluation, and it's not going to be $14 million. What if it's going to be $13 million? I took off $1 million. I'm still at 19%. What if I was extremely wrong and it was only $11 million? I'm still at 18%. This is how I play with the game. This is how I know what to offer at the beginning. Because if this went down under 10, that means that from the beginning I was wrong with what I offered them. So before I give an offer, I do exactly what I'm showing you right now. And I'm going to say, okay, the loan not going to be 60. 60 usually you can get. No bank going to give you too much hard time on the 60% valuation. And I was totally wrong, and interest rate didn't go down, they went up. So I went from 6.5 to 6.2, but with happen 5 years down the road, it's actually going to be 8. So I change the value, I lower the, and I lower the LTV and higher interest rate, I'm still good to go. Okay, I can live with that. Now I'm going to go and say, okay, let's do the same story. What happened if down the road I was wrong when I'm selling it? So let's start doing the same story. I'm going to take it down about $1.5 million. $1.5 million. What is the return? Still over 18. I'm going to take it another $16 million. We're still at 17. I can take it even more if you guys want. But you get the idea, right?
Yeah.
And the last thing that I do is I go back here, and this is for me the ultimate test is I'm going to play with the vacancy. And why is it the ultimate test? Because if I play with a vacancy, I affect all 3 income streams. I have 3 income streams in this deal: rent, refinance, and sell. The value of the property comes from its NOI, which means if I'm going to lower the NOI, I'm going to lower my income stream from rent, but I'm also going to lower the valuation for refinance and for sell at the end.
Yep.
We agree on that?
Yep.
So I'm saying, okay, we already saw at the beginning that my average vacancy is about 3%. I'm already at 6. Let's go to 10. And I'm going to drag it all 10 years. What is my return? I know that I offered the right price. For me to screw it up, I'm going to have a special talent for that. Not because I'm smart.
You have a big cushion on this deal.
What?
There's a big cushion on this deal.
Again, I'm saying not because I'm smart, because I just offered a low enough price to buy it. It's not making me smart. Not at all. I just have enough cushions.
Yeah.
That's all.
By the way, you know, you can have just another sheet called sensitivity and just have one table that you play with the.
But this is more fun. I know. I used to have. If you look at my Excel, my old Excel, I had the sensitivity. I had this. I'm telling you, this is more fun because now I can tell you, okay, tell me what to change.
Yeah.
Tell me what. By the way, when I sit with investors, whoever had the chance to do it with me, this is exactly what I said. Tell me, what do you want me to change? What do you think can go wrong here, we'll do it together.
Yeah.
Anybody want to give an example? I can play with you guys.
Insurance. Play with the insurance.
No problem. Here's the insurance. What do you want me to do with the insurance? This is, by the way, confirmed numbers, but what do you want me to do with the insurance?
Double it.
Double it?
Mhm.
I'm at 12 almost.
Let's say that if you put half of what is supposed to be in insurance, then you're not in the right business.
No, this is, by the way, this is actually higher than what I got. My insurance quote is 180. I already put 190, so my insurance quote is actually 180. But again, you need to understand, Ophir, when I play with the vacancy, it's the same, like, because basically what you're doing is lowering the NOI.
Yeah.
Yeah. So it's the same like playing with the vacancy. This is why I said the vacancy is the ultimate test, because it affects everything. It affects the NOI, it affects valuation, it affects cash flow, it affects everything. You want to see the crazy shit?
Let's see.
I don't take a loan. I run with the one loan the entire 10 years. So this is the advantage of working with when you have a financial model like this, and again, and it's not bragging about that came up, and it came up very nice, and some things worked in our behalf here. Originally, I was at around 16%, so it was a little bit more sensitive. But when you're working with a financial model that specify all of this in this way, and you're thinking about, okay, how can I get my money back? And you're working concentrated on the cash flow and the return. Basically, what you get is a financial model that its sensitivity level is relatively low, because you have, I call it a balanced financial model. It's balanced between the cash flow, the financing, and the Excel. If you're looking, for example, again, I'll take the extreme example. If you take a flip, there is only one exit in a flip, selling it. So if something happened to the sell price, you're done. In this case, if something wrong, because I have so many options here and there is enough cushion, even if something wrong on the sell, on the financing, I still have enough money coming from other sources to compensate for it. Questions about the financial model and how we build it?
Looks great. Simple and straightforward.
Yeah, that's the idea. The idea is to build something that you look at it and you understand what happened. Again, for me, obviously, it's easier for somebody that look at it the first time, but when you get used to it, and again, there is different ways to look at it, and I like it the way that it was. I used to it. It was something that I developed over a period of time. So if you look at the original ones, it was a little bit different than this one, but over time, you come up to something that you're like, okay, I'm used, and it's easier for me to look at, and you get used to it also.
Kyle, it's always a pleasure listening to you. I appreciate you taking the time and showing this to us.
You're welcome. Any more questions about the financial models? Anybody wants to try, play something, put something?
Looks like an amazing deal. Congratulations.
Thank you. This is, by the way, amortization, which is a very important, very easy to build. So if somebody wants to, they go to YouTube how to do an amortization, take exactly 3 minutes.
No, you can do it on ChatGPT. It takes
Yeah,
3
yeah.
seconds.
Today you can do everything on ChatGPT, but I like to do it manually because I'll tell you why. It's a practice. It's a good practice. Oh, well, now it's built, so I don't need to really do it, but it's a good practice, and you can understand exactly how much you own and how much everything goes based on what you're planning to do. But yeah, you can do it to the ChatGPT. Tell you now, that
Tell
guys.
me, when you have a more,
What?
hear me?
You're breaking out a little bit. I didn't understand what you asked.
Tal, can you hear?
Yeah.
Sorry. When you have,
No,
say, you got a new project at the beginning, you raise the roof,
you're
Well,
breaking
what-
out. Ted, you're
the
breaking out.
model is more.
Write it down. I can hear you. Write it down. Do we need Excel? Anybody wants to look at something again, to go over something again? Anyone? Anything? No. Okay, let's take it on. Ted, I lost you. Hello? Disappeared. You guys hear me? Okay. I don't know what happened with him, but okay. Let me tell you a story about the engineering story. Well, let me see if I can find the building. You want to see something funny? This is an engineering story. You're gonna finish with the engineering story. It's funny because I just put this picture on Facebook a couple of days ago. You saw the building that I put on Facebook a couple of days ago with the windows? No, you didn't. Okay. Give me 1 second. Give me 1 second. I'll try to put the picture on. So this building, here we go. You saw this picture, right? So you see how this building is attached to the building next to it? So we bought this land, this building, it's a house, with the intention of demoing it, totally, and building a condominium on it. We never bothered to go look at it. Before I bought it, I never been to the house. For me, this is a construction site. The plan was, the day after I buy it, I'm gonna knock it down. We bought the building, starting closed on it. The next day, we're going for the first time to take a look at the property. We decided we are not knocking it down, we're gonna renovate the building. I'm not gonna get too wide. So we said, okay, new plans, everything new, we're gonna renovate the building. Constructor called me, starting working, doing the demo inside. The constructor called me, the GC called me. My office was about 10 minutes away. The GC called me, said, Tal, you need to come, I need to show you something. So, okay, I'm driving to the building. I'm going in. You need to understand, basically, there is only walls. Everything is demoed inside. He says, Tal, take a look, tell me what's wrong with the building. I'm looking around, nothing. Brick, walls, exactly like I expected. So that, no idea. He said, look again, tell me what's wrong with the building. I'm looking, walls, like, sure, no. Say, come, I'll show you. He goes to the wall between our building and the building next to it that you can see it's attached here. You can see it, right? You can see it attached to the house next to it. He said, look up. I'm looking up, I can see the sky. I say, well, we have like a crack. He said, this is not a crack. I said, what the story is? He said, you can imagine, I never seen it before. Basically, this house have only 3 walls. They use the exterior of the building next door as the interior wall for the house. So basically, there was the wall, and they just built 1, 2, 3. And inside, the wall inside was the outside of the wall of the house next to it. And it was like this for like 100 years. So we had to build a new wall inside an existing building to put it up. So we called the engineer, and the engineer, of course, came with something crazy. And Ted asked me, so I told you. So I bought my constructor by GC and said, listen, this doesn't make any sense. What solution do they have? So they came up with something that they're going to build. They're going to build the frame inside and they're going to add. And then the GC went and told the engineer to build the plans based on what he told him. So basically, we digged foundation inside an existing building and build a wall, an interior wall inside this building that is existing. So this is one of the craziest engineering story that we have. On a different one, we have a different story. Questions, guys? Anybody?
I think that I remember you telling us the story a few years ago. Could it be, or am I just inventing it?
You want to see another something funny that people don't notice? How big are the windows? How big is this windows, do you think?
3 foot by 4 foot.
So how much?
3 feet by 4 feet tall.
Look at the door, the entrance door to the building, and compare it to the
That's
size
not-
of the window.
I couldn't tell if they were as tall as the door or a little bit shorter.
More.
Oh,
So it doesn't look like it, but you can stand and you're not going to reach the top of the window. You can pass through the door. It's like a door. You can pass through this window. It doesn't look at the picture, but I have a picture somewhere of somebody standing on it and his head doesn't reach the top.
Is it a residential or commercial building?
That was a very unique building. That was a two-family. That is a two-family, but basically the way that it was built is that it's one building on the front of the lot and the second building on the back of the lot. And the reason that we decided to keep it as is because today you can't build it like this anymore in New York. So if you have it in grandfather, you can keep it, but if you're not, you can't build it anymore like this. And what funny was a couple of years ago, me and Dor Glicksman was walking on the street on that specific block. We took some pictures because I had 2 houses on the same block. So we took some picture on that block a couple of years ago, and the owner came out and like, oh, why are you guys taking pictures? And I told him I'm the one that renovated it because it was sold. Since I sold it, it was sold again. And she's like, "Oh, this is such a nice house. We love it so much." Like, yeah, I did the renovation. It came out one of the nicest deal that we had at the time. Let's see if I can. Where's the pictures? You want to see the pictures of it inside? So this is a building. So we had like so above, if you look here on top, you can see it here because of the brick, but this is like a lounge. So this is how the lounge look. You come up from the master bedroom and you have a lounge outside, and across the street there was this amazing church. So this is actually how it looks. This is a picture. This is not there. This is how you have like this amazing church across the street. And you sit in the lounge from your master bedroom, and this is what you see.
Beautiful.
Yeah, so that was a bedroom. That was the living room and the dining area. And that was a kitchen. And you can see the second house on the back. Yeah, that was
Looks beautiful.
yeah, I like this house. We did the design on it. It was really, really nice. And we did insert kitchen. You can see that the kitchen, you see how it all slide into the cabinet? So you have regular kitchens that the door comes on top. This is a regular kitchen that is like overlay on top of the cabinet. But you can see here that actually the doors go into the cabinet. Can you see it?
Yep.
And give it a very slick look to the kitchen. The day that I used to do flips. That was a $3.7 million house.
Wow.
Yeah. I think that's what we sold it for. 3.7, 3.5, $3.7 million. Guys, thank you very much. Yeah,
How
sorry.
big was it? How big was the house?
About 3,000 square foot. And
3,000?
Yeah. What's funny now is that I think something like that, if I remember correctly. I have a house now that I need to do a flip on it, a block away. And I've been in court for 4 years with it.
Because
The owner, after signing a contract with us, tried to cancel the deal. It's a house that I have on contract for $1.9 million. It's probably worth today, renovated, around 5.
wow.
And it's in court. Once we're going to finish, it's going to be the next there.
Wow.
The funny stuff was that people don't understand. She didn't understand. When we signed a contract with her for 1.9, that was the market value for it. She took us to court. So during court, basically,
What's her claim?
she doesn't have a claim. She just don't want to do it. No, she already lost. It's in appeal. She said she don't understand that because of inflation, she lost so much money. She don't even understand it. Well, she died now, but she don't understand it. I still need to pay her 2019 price for a building that since then went up in price probably 15-20%.
For sure. Wow.
This is how it works. Guys, thank you very much. we're gonna call it a
תודה
day.
רבה, טל.
If you have
תודה
any
רבה.
question, anybody, let me know. I'll be more than happy to help.
Thank
Tal, will
you.
you send us the
תודה רבה.
recording and maybe the notes that the AI creates?
I don't know what notes I create. I didn't ask him to create any notes.
Okay. I thought
Eh,
Vadim, it looked like Vadim created it. I'll ask him.
Ask Vadim, no problem. Do you have a recording? What do you need notes?
No, sometimes it creates by itself. Do you see fireflies.ai note taker under? Do you see it on the list of people?
Vadim, ask Vadim for that.
I will.
I'm
Okay.
an
Thank you
old-fashioned
so
guy.
much.
I'm an old-fashioned guy.
טל, תודה רבה.
I think Zoom does it by itself. So if it does, please send it our way, okay?
No problem.
תודה רבה. לילה
Thank
Thank
טוב.
you, guys.
Yeah.
Have a good day.
יום נפלא, ביי.
Bye-bye.